In this video, I'm going to talk about something called the basic accounting equation. This equation is absolutely fundamental to your understanding of accounting. So let's go ahead and write out the equation. We've got on the left-hand side, we have assets. This is the left-hand side of our equation. Assets are always equal to liabilities, which is otherwise seen as debt, borrowing, plus equity, which is the owner's share of the assets. So we've got the right-hand side of the equation, all this over here, and then we've got the assets on the left-hand side. This equation will always balance. Always. Always balances. And in fact, this is something you will see on the balance sheet. You'll always see any balance sheet, the assets will be equal to liabilities plus equity. So when we think about conceptually what is going on here, well, there's a few things. So first of all, the assets are things that the company or the business owns. For example, cash, could be some accounts receivable, property, plant, and equipment, things like buildings. We've got intangible assets like trademarks, investments. All these different things are things that the company owns. But although the company owns these things, there are different claims on those assets, and that's what's represented by the liabilities and equity side. These are claims on the assets of the business. But these claims come from two different sources. So we've got the liabilities, which is debtors. So for example, you borrow money from a bank, you owe this asset, there's a claim against it by a bank. So that's the debtor side. And then this equity side is owners. So the equity side represents claims by owners, and then the debtor side is claims against the assets by debtors. So this is a little abstract here. So let's go ahead and just think about this in terms of if we actually started a business. So let's say we're going to start, you want to start a DJ business. You want to be a DJ at weddings. So you start your own DJ business. Well, you're going to have to buy some equipment. So you purchase equipment, and let's say it cost $5,000. So you purchase equipment for $5,000. And let's just pretend, let's keep things simple here. Let's pretend that this is the only asset for right now that we're concerned with, that you've bought. This is the only thing that you own. Make this a very simple world here. So that equipment is an asset. So what's going to happen is, if we were to look at your balance sheet or to do this accounting equation for your company, we're going to have $5,000 on the left-hand side. And then that $5,000 in assets, this just corresponds to this up here, is going to be equal to liabilities plus equity. So how do we figure that out? Well, we have to figure out, how are those assets paid for? Well, let's say that you went and you took $1,000 out of your personal savings, which was separate from the business. Just you put $1,000 of your own money into the business. Well, that's the equity portion. That's your claim against the assets of the business because you are the owner. So you've got $1,000 here in equity. But how else was this purchase of the equipment financed? Well, let's say that you borrowed the remaining $4,000 from a bank. So now we can represent this in terms of it. We've got assets here on our left-hand side, and then we've got claims against those assets on our right-hand side. Okay, we've got $4,000 in liabilities here. And then we've got $1,000 in equity. But let's say for a moment that you decide that you want to invest, let's say you want to invest $200 cash after this. After all this is taking place, you say, I just want to give the company $200 cash and it'll use it at some point in the future. Okay, so what's going to happen is this. So now we're going to add that $200 over here. And now the company is going to have an asset of $5,000 in terms of its equipment plus $200 of cash. If we were to look at its balance sheet, that'd have $5,200 in assets. But that has to equal the right-hand side. If the left-hand side goes up by 200, then the right-hand side must go up by 200. So then we say, okay, how was that increase in assets? How was that financed? Well, did we borrow the $200? No. The owner put it in from his own or her own personal savings. So the debt, the liability side, is going to stay the same because we didn't borrow to get that. But now the owner, he or she, has an extra $200 of equity. So if you're the owner, now you have $1,200 in equity. There's $4,000 in liabilities, and here's your total assets. Whatever you do to the left-hand side or to the right-hand side, there has to be a corresponding change in the other side of the equation so that both sides are equal to each other. This is the basic accounting equation.